Good morning. Everybody got a wonderful night's sleep, and to take a traipse around the paddock. It's a little bit less hectic here today than last week. We were here for the Derby with a few clients last week. Compliments of Ken Perry and some of our friends here in Kentucky. So thank you for that. What we want to talk about today is really the industry overall and how it's changing on a national level. And then a number of you are going to break into the changing landscape of Kentucky tax liens particularly, and how they fit into the overall national landscape. But we thought that perhaps it makes a little bit of sense to take a step back and to look at how liens fit into the general, thank you so much, how liens fit into the general capital markets. They are indeed a fixed income investment after all. Do we have a clicker, Stephen? Or are you can do that? Okay, great. They are indeed a fixed income investment after all, and they fit into the overall capital markets in an interesting little bucket that is very undersung, especially on Wall Street, where I spent a few years trading at firms like Morgan Stanley, J.W. Seligman on the fixed income side, Lazard. But if we look at tax liens, not necessarily just on a local level, which is, as all of us know, where they live, and it's very much like real estate because there's very different rules. But if we look at them on a capital markets level, you see the comparison to the fixed income markets in the equities markets here, right? So if the public IPO, the initial public offering for a primary market issuance of a stock, which many of us have probably invested in at some point in our lives, is the kind of large, giant marketplace that Wall Street likes to trade. The majority of the market share for those is the New York Stock Exchange, as you see with the big light blue market share thing, the NASDAQ, as you see with the dark blue in that pool. There's also a subcategory of equities, right? And that is the private shares market. So the private shares marketplace, pioneered by places like Second Market, Barry, who's a friend of mine, Shares Post, and some other very, very interesting small Wall Street type companies, basically took this idea of initial public offerings, which are an SEC regulated, FINRA regulated in many cases, concept, and they took a niche of it and brought it to the general investing public. So this equities market is a sub-market of the IPO. Similarly, we see tax liens as this sub-marketplace of the general fixed income market, right? And when we highlight this to a number of our clients, it really puts some weight on the fact that this really is a fixed income investment, not a security, but a fixed income investment that is incredibly important to bolstering a number of the communities across the United States. And so, in way of an analogy, the primary market for bonds is the municipal bond market, right? Or the corporate bond market, et cetera. Bonds.com, my former CEO when I started the first secondary market at GFI Group, which was actually just acquired by BGC, by Howard Lutnick's company. Bonds.com, he sits on the board of, so they have a pretty large market share in many of those secondary market transactions. There's the ERSA and then a number of other informal secondary markets for bonds, but there's no real exchange for bonds that's ever existed for these fixed income instruments. I don't know that there ever really will be. It's all OTC, or what we call over-the-counter trades, right? There's a lot of phone work involved, a lot of people sitting on desks in the middle of New York and Chicago and everywhere, trading blocks and odd lots of these fixed income instruments. But the marketplace is astoundingly large, and it really eclipses the equities marketplace on a global scale. So I say this to highlight the fact that our little niche in tax liens is, just like the private shares market, a subset of this larger fixed income marketplace, and really does have a very, very crucial, important place in the world of capital finance. And so we are at BlockTrade, which is one of the BCMG holdings, as Stephen mentioned before. We're the largest secondary market for tax liens in the world. Right now, we only trade in about 24 out of the 29 states consistently, but Kentucky is one of them. We have a number of listings, over $60 million worth of listings in the state of Kentucky, which is one of the reasons why we're here today. And there are some other competitors that have come into the marketplace who are friends and colleagues of ours, like the Lumentum brokerage platform that trades in the state of Florida. So on a capital market scale, tax liens fit into this whole picture at the issuance level. Right, they go to fund things like schools, as you all know, public works, roads, etc. But they really have some of the very same characteristics as a general obligation bond might have, or even a special obligation bond on the primary market. Where do they fit in terms of size? They're relatively de minimis. Which is why we're able to kind of fly under the radar, if you will, and people don't want to run in and compete with us in our wonderful little subset of the world. But if you just look at some of these numbers, the fixed income marketplace, the size of the fixed income marketplace is really astounding. And then we see our little tax lien marketplace with 10,000 millions or 10 billion is about the estimated issuance, but nobody really knows what the actual issuance is, because the NTLA and our former trace study just did not conclude exactly how many liens were issued. But this gives you a little bit of an idea of where we fit in the overall capital markets. So where are we trending? Where are we going as a nation? The primary market in 2014, right, so direct from municipalities like Louisville to the investing public, whether it's John and Jane Investor or whether it's formerly JP Morgan or one of the larger institutions. There were probably about $9 billion worth of liens sold last year. In 2015, we do see, or we do anticipate, a decrease in that, and much of that decrease is as a result of the Florida auctions being significantly less, which are actually going on right now. The Florida auctions being significantly less than they were in previous years. But the interesting correlation between the primary and the secondary market, which is investor to investor, is that when investors like yourselves, right, or your clients can acquire less liens, right, or less assets in the primary market, they turn to other alternative means, right? And so they turn to platforms like BlockTrade, like Lumentum, like the kind of shadow secondary market, and they try to acquire more liens. And so in 2014, we estimate there were about $250 million worth of liens that traded hands. About 98% of that occurred over the BlockTrade platform. In 2015, however, we estimate there's about $1.75 billion worth of liens that will be listed and traded hands. We have already listed at BlockTrade over $350 million in the first quarter of liens, so we do see this trend holding very strong. These were projections from the beginning of the year, so the reality is we put it probably closer to 1.25 to 1.5, but still, even at those numbers, it's an astounding difference, and it really does highlight that the secondary market is catching on, and that in order to achieve yield or in order to achieve liquidity, whichever of the two you're looking for in your fund or your clients are looking for in their fund, it's really necessary to look outside of the kind of traditional primary market auctions. So what are the benefits of a secondary market in kind of the national landscape? And then we can get down to Kentucky specific. The issuers, right? So these are the municipalities, these are the counties, and they want to raise capital. We all know this. They want to support infrastructure, but more importantly, especially as we're seeing in our home territory / state of Puerto Rico, they want to fund operations, right? The need for short-term cash is so acute right now that people are making very arguably questionable decisions on political fronts, on financing fronts, across the entire United States of America. And what people don't understand in about half of the states is that there's this interesting financing vehicle available to them called the sale of property tax liens. And our friends at the National Tax Lien Association, especially on the legislative committee, Jim Meeks from MTAG and some of the other gentlemen there, are making really, really concerted efforts under the leadership of Brad Westover to go to new states and open up these new marketplaces. They've been doing some phenomenal work in Philadelphia and a number of other jurisdictions to show that in these dire straits, in this real need for short-term cash, while paying attention to long-term opportunities, there is this investment vehicle enabled in almost all of the states that they could issue tax lien certificates, which of course would grow our broader marketplace and hopefully make that $7 billion number a little bit bigger for next year. So that's the issuers. And the issuers get cash, the issuers get immediate liquidity, and in most instances, the issuers do not have to take a discount, right? In the state of Kentucky, it's not, negotiated bid sale like it is with our neighbors in Ohio. You are taking 100 cents on the dollar plus some fees, right? So this is a great thing for the community, and it's an immediate injection of cash, an immediate injection of liquidity into the balance sheet of these municipalities. So if the issuer benefits so much, then how does the buyer benefit? Well, first, who are these buyers? Who is this kind of middle bucket, if you will? We'll talk a little bit more about that in 2 or 3 slides, but they traditionally have been very local. In the 90s, mid to late 90s, they moved to much bigger institutions. I'm sure a lot of the local investors here saw that squeeze. It hurts a little bit on the local buying front, but then you're also seeing some defaults as of late. You're seeing a little bit of irresponsible purchasing in terms of relaxing of due diligence criteria, et cetera, from some of the major institutional guys. And so you're going to see a lot more regression back to smaller funds, small to mid-sized funds. And so these buyers, these small to mid-sized funds, or these local investors, or these mom and pop shops, are looking for unique investments. Right? And so when they come to the secondary market, they're looking for unique products, stuff they can't get anywhere else, and stuff that maybe they weren't able to win or achieve in the primary marketplace, and that's what they find. The second thing that's a little bit different about buying in the secondary market than in the primary is there's a lot more data available. And what I mean by that is you already know what the interest rate or the penalty rate, depending on the state, of the particular portfolio or the individual liens that comprise the portfolio is. You already know what the duration is. You can take a look, generally speaking, at what the redemption curve has been for that portfolio. You understand the seller a little bit and how they service and maybe how the counterparty risk might be able to be assessed. And then, of course, you know all of the same things that you know in the primary market, right? Brian Seidenziger from Tax Sale Resources is here. They provide some wonderful primary market due diligence on a property level, on a lien level, on our Lien Analytics platform under the BCMG flag. We provide some interesting lien information and tax collector information. And so you can see all of that information and make an assessment on these portfolios as a whole or individually. And there's also immediate availability. The one thing that a lot of our secondary market investors talk about is I can call you up, and yes, I mean, it's subject to market supply, but you can call up, and for the right price, you can execute a portfolio of tax liens relatively expeditiously. You don't have to wait around for that auction the next year in a particular jurisdiction. And then, of course, the sellers achieve maximum liquidity. They're able to sell their portfolios, as is evidenced in many of the medium and large guys these days. They need to sell tails of portfolios. They need to sell portfolios that perhaps don't fit the investment criteria or the lending criteria for eligible collateral for the banks that are out there these days. And the seller maintains complete control over the transaction, similar to municipalities in the primary market. And of course, they get some additional analysis on the sell side that allows them to look at the counterparties and control who can bid, who can't bid, et cetera. So with the rise of these secondary markets, we really do see the benefit to the issuers, the buyers, and the sellers. So how did we get here? And we want to talk a little bit about how the future of tax liens, which we kind of put in this access terminal type bucket, arrived from back in the day where we used to have physical certificates everywhere, which actually used to happen in the municipal bond market too. So in way back in 1900s, which I don't think we can remember, there were localized small buyers that really provided liquidity to their neighbors, right? People have been selling, well, first of all, even before that, tax liens are a feudal concept, right? The concept of a lien or a title on a property comes from the ancient feudal ages. And so when those type of rules were enacted as law here in the New World, many of the states, then commonwealths or territories, were enabled to kind of sell off these receivables in the form of tax liens. So there have been some forms of tax lien sales. I'm not sure about Kentucky. Maybe somebody here can address that in their presentation. But there's been some form of tax liens in the states for over 100 years. In the beginning, it was localized small buyers, as you might expect. Just like real estate, tax liens are very local, right? Because at the end of the day, regardless of what you want to believe, you are making a real estate play. The underlying collateral is incredibly important to understand. And so you've had localized small buyers for quite some time, buying up tax liens in their local communities or in the neighboring surrounding communities. Then what you had in the late 80s, early 90s, all the way up through 2000 was you had large banks and wirehouses came in. Lehman Brothers was a large player. JP Morgan, through their former subsidiary Expand, was a large buyer. I'm sure some of you remember Capital Asset Research and some of the other larger players that didn't fare so well in the marketplace came in and started using very aggressive leverage. And why did they want to come in? They wanted the yield, right? They wanted to come in and be able to have excellent risk-adjusted returns, as Stephen alluded to earlier. They wanted to be able to have an asset-backed product, and they wanted outsized returns. Basically, they wanted it all, which many of us can relate to. But they really had a heyday for a number of years going in and sweeping this marketplace. In some states, there was enabling legislation put in. Kentucky is not really an exception to that. That really empowered a lot of the smaller localized investors, which a lot of us think are a very good thing, because concentration of liens in the hands of just a few large players isn't really great for any of your clients, and it certainly isn't great for an efficient capital market. So we're all on the same page there. We don't like that consolidation. Then, as we moved into 2000 to 2010, you started seeing banks move away from buying liens for their own balance sheet and move towards buying liens in a different way. They would lend on these liens, right? Now, there's always been some form of lending. There's a lot of local banks here that lend. There's a lot of local banks in Chicago that lend on Kentucky tax liens. But now we were seeing people pop up like Capital One, like Wells Fargo, lending on large national portfolios in a very thoughtful, very deliberate way. And so what this did is it enabled these middle market investors that were able to go out to the marketplace and, through a friends and family round or through a real PPM or through whatever type of public offering it was, raise $1 million, $5 million, $10 million, $20 million, and get some, again, very thoughtful but aggressive leverage as far as kind of the broader capital markets picture goes, and have much bigger funds, right? So somebody that before could only buy $5 million in tax liens in one state now is able to go and acquire $30 million in tax liens in 4 different states. And this was an enormous game changer. And this is really right around when I started buying tax liens for my personal book, right around 2003. But on an institutional level, I started buying in there, and that's what enabled me and Sycamore Capital Partners, the fund that I used to run, to do that. And so I have a very personal experience with how the more available leverage, if you will, for these small to middle market buyers really changed the power from these large institutional hands to these leveraged middle market funds. And then naturally, with the progression of, or the maturation of any marketplace comes specialization, right? And so people always traded tax liens back and forth. I mean, I'm sure that all of you have stories of, your clients or each other titling one lien here, one lien there, 20 liens here, 20 liens there. So there's always been a secondary market informally. We like to call it the shadow secondary market for property tax liens. And most states allow you to do this. South Carolina really is a little bit more prohibitive, but the majority of states, including Kentucky, allow you to do this relatively easily. It's just really clunky, very difficult to price. So the spreads are very wide. It's an incredibly inefficient marketplace, or it has been. So the capital markets saw this. And I came to a firm called GFI Group, which is a big firm on Wall Street. As I said previously, just got acquired by BGC, but they were GFIG on the New York Stock Exchange, if you ever care to look them up. But we started what is now known as the first real formal secondary market. It wasn't a novel idea. Everybody has tried to start secondary markets for 20, 30 years. I certainly wasn't the first person to think of this. For one reason or another, we were just the first ones that were able to achieve enough economies of scale to make it work. And then we listed in the first February 2010, we founded the marketplace. And in the first 13 months after the launch of the DART platform in November of that year, excuse me, we listed about $1 billion worth of paper, which was a wake up to the marketplace, because everybody said that it just really couldn't be done. Some of you were clients of ours back in the day, and we certainly appreciate that. And once we proved to the marketplace that it could be done, we started doing larger block trades with the likes of Fortress, with the likes of Bank of America, with the likes of Deutsche Bank. And then, of course, our bread and butter was then, and still remains to be, in the secondary market, small to medium buyers and sellers. That's really where the liquidity lives in this space. And this was also part of the reason why we wanted to expand tax lien talk, as Stephen said before, from one national conference to kind of, pat each other on the back and celebrate, our top 100 clients, and we could all, hang out together in Puerto Rico last year, Bahamas this year, and kind of celebrate the year and the successes and talk about trends on a national level. We said, no, tax liens really are a local thing, right? And so what we wanted to do is expand this offering state by state, and to start with some of the most important inefficient states, and to say, we are here to empower all of the service providers. We're here to empower all of the local investors, all of the funds that might invest, $1 million, $2 million just in this state, that state. We really offer the most value to those types of marketplaces. And so that was, as Stephen said, that was really why we wanted to expand this conference series to 7 states this year and more next year. So the secondary market changed things a little bit, but it didn't really fundamentally shake up the marketplace. The first couple of years we had about 100 million that were actually traded out of $1 billion listed, so 10% of the market moved. There were really, really big issues in the trading of tax liens, and the biggest problem was that the spreads are too wide, right? You have a bunch of sellers that want huge premiums and a bunch of buyers that want to buy at crazy discounts, right? So if any of you have ever traded bonds, I hope you haven't, that's what I used to do. I know Mike has. If any of you ever traded bonds, especially on an institutional level, Mike traded at Lien, the spread is a very, very frustrating thing when you come into pools of relative illiquidity. And so what we've been able to do over the last, 4 years, through the GFI secondary market, and then when I transitioned that marketplace and I purchased the division and moved it to become Blocks Trade, which is where we trade out of now, we've been able to narrow those spreads, and we've been able to trade more of the paper, and we've been able to achieve liquidity for our clients much more efficiently, and that makes them happy, right? Sellers get their money, the buyers get their product, and everybody goes away happy. And so I'm not saying by any means that this is an efficient marketplace. I'm not saying by any means that this is the NASDAQ and we're going to be trading, with tiny little fractions of a percentage. This is these are tax liens, right? These are going to be traded in very, very slow blocks. These are traded over the counter. It's traded by appointment. I don't see that changing anytime soon. So don't worry, your spreads are still going to be there, and there won't be too much efficiency where they're going to, suck all of the return out of the marketplace for you and for your clients. But what I am saying is you're seeing more tools that help you to achieve better returns. So then in 2014, we saw some very deliberate and aggressive consolidation in the tax lien marketplace. We achieved some of that ourselves under Bespoke Capital Markets Group, and then we made a move to Puerto Rico for some tax efficiency reasons from New York, where we were for 9.5 years. And consolidation from the bank level, consolidation from the fund level. You saw some of the very, very large funds that perhaps in the past had played in the periphery of the market, funds that were publicly traded like Encore Capital. I don't know if anybody saw the purchase of Propel from Encore Capital for $186 million. You saw the purchase then of the JP Morgan portfolio by Propel. You saw some of these large transactions take place, and a lot of consolidation to the middle market players from people that didn't really want to be in the business anymore or couldn't afford to be in the business anymore. And on the service provider side, at least from the BCMG level, we started consolidating all of our companies as well, because we really started seeing the tax lien marketplace very holistically. So we said, all right, let's put everything under this little BCMG flag. Let's put Tax Lien Talk under there as our educational community outreach type organization, and Tax Lien Talk is now nonprofit. We put Lien Clear, which is our clearing firm over there. We put Blocks Trade, which is this, the secondary market we've been talking about so much. We put Lienalytics, and then we ended up buying 2 or 3 other small data and software platforms as well. And so you saw kind of this converging of things. And then what we wanted to speak about just very briefly is where we are trying to go as a consolidated marketplace is into the technology sector, right? So we launched this thing called Access Terminal at the National Tax Lien Association event in Fort Lauderdale, which we saw some of you at. And we were fortunate enough to be able to present the Access Terminal and demo it for a number of our clients. People seem to be liking it very much. And the idea of Access Terminal is this. BCMG and BlockTrade and all of our different companies, we are feeling a lot of the same pressures that the general marketplace is feeling. We're feeling a lot of the same pressures that you and your clients are feeling. Spreads are going away in other states outside of Kentucky. Arizona this year went at 2-3% because of some very, very large aggressive buyers. Florida continues to be an incredibly aggressive marketplace, which, as I said before, is going on right now. And so you're seeing a lot of pain in marketplaces outside of some of the more robust local marketplaces like Kentucky. And so we said, we want people to be able to evaluate their businesses as a whole. And part of the reason that people haven't expanded, other than the fact that they couldn't get leverage, which was fixed, as we said, in 2000s, was it's really prohibitive to build your own technology. If you're still using Excel spreadsheets and Access databases, not Access Terminal, but Microsoft Access databases, and all of these different things, it's very difficult to manage portfolios, as I'm sure many of you can attest to. So what we tried to do with Access Terminal is really to be the Bloomberg of tax liens, if you will. So before we talk about that at all, who are the players? And each of you in this room fits into one of these buckets here, right? So there's auction providers, which in the state of Kentucky are on a municipal level. There's no online auction providers as of yet, but you have Real Auction, Grant Street Group, SRI in Indiana. Then you have your sellers, In the secondary market, the sellers are institution. In the primary market, the sellers are the municipalities. The buyers, which are all of you and your clients. The brokers, which are us and our competitors. The issuers, which again are the municipalities. You have the bankers, which many of us don't deal with except a few in this room here, who are kind of the advisors to the issuers in the same way that the brokers are the advisors to the institutional sellers. You have the marketplace, which as a whole doesn't really exist yet, which is a very cool concept. And data providers, as we spoke about before, market makers, which is a whole nother story, and clearing providers that move the paper from the seller to the buyer. So how do over-the-counter marketplaces work? Just like this. The seller lists, the broker shops it out. They go to the data firm, they get a bunch of data. The broker goes to the marketplace. It's pretty simple. It's pretty easy. And then on the buy side, the buyer comes in to the marketplace via their broker. And this is the way that it works in every capital market, by the way. The buyer comes into the marketplace via their broker. Excuse me. Negotiates with the seller or with the market maker, who is a buyer of last resort. And then once they agree on a price, it goes to the clearinghouse. They clear with the municipalities. Everybody's happy. Sounds easy. It's not so easy when you try to execute it. So the idea of Access Terminal is that you get all of those players, all of you, all of these inefficiencies, all of these over-the-counter processes on one terminal. And so the benefit to the banks, to the buyers, to the attorneys, to the issuers, to the municipalities, to the sellers, is that there's immediate access to all of these things. Oops. And so this is just a couple screenshots of the terminal, which we can talk to you guys about later if you'd like. But the idea is you log in as a buyer or as an attorney or as a bank, and you can see all of the auctions coming up. You can see all of the lists coming up. You can do all of your due diligence, but you don't have to choose just one service provider, right? The whole point of Access Terminal is that you can have all of your service providers for each of these things, whether it's data, whether it's clearing, whether it's brokerage, whether it's law firms, whether it's foreclosure. You can see your service providers lined up against each other in one place so that you can manage your portfolio much more efficiently. And so it's really just standardization across a number of different levels. And so as you can see, you can drill down to individual levels. You can sort and filter and do all of your normal due diligence things for those fund managers out there in the audience that you would be able to do otherwise. And then, of course, on an individual portfolio by portfolio or lien by lien level, you can see all of the different data. You can choose to bid. You can choose to do order drive-by photos and from various providers, and move on to the next stage of due diligence. The secondary market, it works very similar to the secondary market we have today, which is you see listings, you see liens, you can cherry pick portfolios, you can bid on these, you can do due diligence using the tools from 2-3 slides ago, and you can share them with your investors. And clearing, same thing as well. You know, we just walk you through the steps that it takes between the seller, the municipality, the clearing agent, and the ultimate buyer. So that's really how we view the consolidation of the marketplace from a national level. And these are some of the things that we've tried from BCMG's side to bring into the marketplace in order to help enable each of you to run your businesses a little bit more efficiently. So as we see a lot of pain in the tax lien marketplace overall, which is expressed by our clients, by our prime partners, who are all of the attorneys and the other clearing and data people that we work with on a day-to-day basis to help them run their businesses, we do see that some kind of offering on a technology side has been the request for quite some time, and we hope that this can at least help out. So, any questions about the marketplace overall, about what we do, about what our competitors do, about where Kentucky fits in? Yes.
Your terminal software that you showed up there, is that specifically for the secondary market, or is that to help with the primary market?
That's a great question. Does everybody hear that? Is a terminal for the secondary market only or for primary? The terminal is for everything. The idea is that the access terminal is the central hub, and there's a secondary market plug-in, we call them portals, a secondary market portal where you can trade in the secondary market, but it's also for the primary market, right? So we have a primary market due diligence portal as well. So you're able to see the upcoming auctions, you're able to see all of the different data providers that you could purchase data from for those upcoming auctions, and you're actually able to write notes in there, you're able to say bid, don't bid, and then it communicates directly with the auction providers if they're online. Or if they're not online, you can just export it and bid the way that you would in person. So it's for both primary and secondary. And it's also for servicing too.
If I were to buy something on the secondary market, I know there's enough problems with paperwork with mortgages. How do you help take care of the paperwork required for notice requirements and everything in order for me to go to foreclosure for something I buy on the secondary market?
Sure. And the answer to that question is incredibly state specific. And Lien Clear right there is our version of the DTC, the Depository Trading Clearing Corporation, one of the largest corporations on the planet that nobody's ever heard of, that moves all the bonds and paper back and forth in the stock exchange, or Euroclear. So we have a very, very simplified, much, much smaller version of that, right? So what we do is transact, sign, transfer, and settle is pretty much how Lien Clear works on our proprietary one. Our competitors all have very similar platforms. So it depends on the state. So in a place like Kentucky, it's much more paperwork intensive. In Florida, everything's book entry. It's very, very easy. We can move paper relatively quickly. In Kentucky, there's a number of different processes, which we can talk about offline, but the first step to everything is validation of the liens, right? You need to validate that the counterparty is real. You need to validate that the liens are real, that they are indeed owned by that counterparty. And as you said, that the appropriate noticing's been done. And some of the onus of determining whether that noticing has been appropriately done falls on the seller, right? After we've agreed on price and terms and purchase and sale kind of term sheet, if you will, then we put the onus on the seller to say, okay, provide this noticing, provide this, provide these different forms of documentation to prove that you have indeed done X, Y, Z. And a lot of that collaboration is with the attorney in a state like Kentucky. Once you have that, we will then go ahead and execute the transfer forms for you, right? So we collect the money into escrow from the buyer, from the purchaser. We use U.S. Bank because it's one of the biggest banks in the world and everybody seems to trust them. So we use them as an escrow agent. We put the money in an escrow account, and then the seller pledges their liens as collateral. We either physically transfer the certificates if it needs to be physically transferred and stamped and notarized, or we submit the appropriate form to the county if it doesn't need to be physically transferred. And then once we get a receipt from the county or the municipality that says that the lien has indeed been retitled into XYZ Fund A, the buyer's name, then we'll release those funds out to the seller. And of course, there's a reconciliation process that happens as well, which is kind of the hardest part of all of it. There will be liens that don't transfer, right? There'll be issues because something's in bankruptcy and it wasn't able to be transferred, or the lien redeemed during the process, or a litany of other issues. And so what we have is a very just clear, deliberate exception report process where we net the funds back to the buyer and the liens back to the seller in those cases. Brad, did you have a question?
You mentioned the problem of excessive spreads between the buyer's expectation of discounts and the seller's expectation.
Yeah.
Now that you have this what would you say is the typical price for the pool? And I would sort of frame the answer in the context of the way the amount due is calculated here in Kentucky. As you know, the original principal investment is the first component of the amount due, and I call it the certificate price. Mm-hmm. And then you have the accrued interest of 1% a month, simple, and then you have a collection, what I call collection charges.
Sure.
Does the seller usually get any of the collection charges back as part of the sale?
It's very, very asset specific. So typically you're going to recover your principal amount, right? The certificate value, we call it face value. The administrative fees in the state of Kentucky being kind of part and parcel with that, right? So the 100, 115, depending on the year. And then, of course, you have the accrued interest. In most other states, that's really where your negotiation happens, is in that accrued interest, because that's the difference between the face value and the current value, the redemptive value. Here, then you have, on top of that, your pre-litigation fees, your litigation fees, and otherwise, as you stated. It depends really on a number of factors. Number one, how aggressive the seller was at applying these litigation fees. Bless you. Number two, it depends on documentation for those. Number three, it might depend on certain lawsuits, class action lawsuits, et cetera, in a particular state. Number four, it will depend on how recoverable the purchaser really feels that those fees could be. And so it gets a little more complicated in Kentucky than many of the other states. But in practice, yes, we have seen portions of those fees recovered. The question of how much of those fees recovered it's all over the place. Does that answer the question? Anybody else? Well, thank you guys very much. We appreciate you being part of this, and look forward to hearing from the other speakers.